Shall I start, sir?
Yeah, sure. You can go ahead now.
Right. I'm Anupama Dharmarathne.
Yeah.
My project, I'm going to present my project on Classic 6 ice cream. I'm working for the company called Frozen Foods Private Limited, and our main products are ice cream, frozen drinks, and frozen yogurt. And we have planned to implement a new project, that is the introduction of a new ice cream that adds 6 flavors into one ice cream tub. So therefore, we are initially planning to produce 1-liter ice cream tubs, and we have looked for a machine that can pour 6 ice cream flavors at once. But unfortunately in Sri Lanka we couldn't find such a machine. Therefore, we have found a machine in Denmark, and we are planning to import that machine from Denmark, and the cost of that would be 10 million rupees. And so we have actually thought of financing the cost of the machine through a bank loan. And since we have a good relationship with the bank, we expect that the capital portion of the bank loan will be repaid only after the first 5 years. Then the features of our project are: price of 1 liter of ice cream would be 400 rupees, and the variable cost of 1 liter of ice cream would be 210 rupees. Fixed cost per year would be 500,000 rupees, and the cost of the project, which is the cost of the machine, would be 10 million rupees. The tax rate is expected to be 28%, and the forecasted sales are as follows. In the first year, sir, we are planning to produce 15,000 liters, and in the second year we expect the sales to grow by 20%. Okay. So the number of liters would be 18,000. Okay. Third year we expect sales to grow by 15%. Okay. And fourth year we expect sales to grow by 10%. And in the final year, fifth year of the project evaluation period, we expect sales to grow by only 5%.
Okay, good.
Then the capital structure of our company: equity is 90 million, that is proportionately 90%. Okay. Debt would be 10 million, then 10% proportionately. Yeah. Then a pro forma income statement. Sales, the working is like 15,000 liters into 400 rupees per liter, 6 million. Then year 2, 7.2 million. Likewise, then variable cost would be 210 rupees per liter into 15,000 liters in the first year. So 3,150,000 in the first year. Then the contribution or gross profit would be 2,850,000. Fixed cost 500,000 per year is reduced. Then the depreciation, the cost of the machine, that is 10 million rupees. We expect that cost to be depreciated on straight line basis for the 5 years. So therefore 2 million per year depreciation. Then earnings before interest and tax would be 350,000. Interest portion, we expect the 10 million bank loan to be taken at 12% interest rate. Therefore 1,200,000 would be the interest. So in the first year and the second year, profit before tax is a negative figure, and the net income is a negative figure. Then in the from third year onwards, we are expecting a positive net income. Then the balance sheet: land value is given 90 million, machinery 10 million in the year naught, and then it's depreciated. Then cash balance is given, and capital portion, retained earnings, and the bank loan is up to 5 years. It's 10 million because we are repaying after 5 years. Okay. Then the operating cash flows: earnings before interest and tax is taken. For that we have added the depreciation amount and reduced the tax. Then a net operating cash flow figure is given to 2,350,000 in year 1, 2,920,000 in year 2 likewise. Then projected cash flows, initial investment is 10 million, then net operating cash flows 2.3 million in year 1, 2.9 million in year 2 likewise. Then to do our analysis, we had to calculate the weighted average cost of capital.
Okay.
So the government treasury bill rate is taken as the risk-free rate, and the prevailing rate for 364 days is 10.37%, sir.
Yeah.
Therefore, we have taken an approximation of 10% as the risk-free rate.
Okay.
And Ceylon Cold Stores PLC, that is the Elephant House Company, which is a similar company, we have taken as the proxy company. Their beta value is 1.7, and that we have used for our WACC calculation. And the bank loan is taken at 12% interest rate. Therefore, the cost of debt will be 12% after adjusting for tax. And the market return is expected to be 13%. Then the cost of equity calculation. Cost of equity is 15.1%. Cost of debt is 8.64%. Weighted average cost of capital is calculated at 13.6%.
Yeah.
And since we are importing this machine from Denmark, we have kept a premium as because of the exchange rate risk. Usually Danish krone is fluctuating between 19 rupees to 21 rupees. Therefore, we have added a 10% premium to the projected weighted average cost of capital. Therefore, the risk-adjusted cost of capital is 15%.
Okay.
Then using that, we have done our analysis through payback period, net present value and internal rate of return. Then the payback period is calculated at 3 years and 4.5 months, which is good because we are recovering our cost before the end of the project period. Then the net present value is 446,000 rupees, a positive figure. Then the internal rate of return, 15% is the lower rate that we have taken, and 20% discount rate is used as the upper rate, where we have got a negative figure of 774,000. So using that, we have calculated the internal rate of return at 16.8%. Then these are the reasons for our recommendation. The net present value of the project is a positive figure of 446,000 rupees. Internal rate of return is estimated at 16.8%, which is higher than our projected cost of capital. And the payback period is 3 years and 4.5 months. And also, Classic 6 project will generate positive net cash flows from the beginning of the period. Therefore, we have recommended to undertake this Classic 6 ice cream project, as it will increase the wealth of our shareholders. Thank you, sir.
Okay. Right. So, relatively good presentation, Anupama. Really. Hello.
Thank you, sir.
Yeah, I appreciate because
Yes, sir.
you have followed the real way of that making a presentation. So I
Thank you,
appreciate.
sir.
So then this is the company coming under the Ceylon Cold Stores.
No, sir. This is a hypothetical company.
Hypothetical company. Okay. Now, so
Yes,
therefore
sir.
that just for the clarification. So the beta value you have taken on what basis?
Beta value, sir, I have taken from the Colombo Stock Exchange value given at all share price index.
No.
Cold
So
stores.
the beta value that you I do remember that you 1.4
7.
1.3. So what I'm asking
1.7, sir.
1.7. It's risky company. So no the one. So
Yes.
when that we are applying now we have to
Yes.
have a rationale. I'm asking that rationale. So What is the rationale? Rationale is that we have to argue. So, if this kind of a project that you are implementing, then
Yes.
you need to take as that vita, that is a riskiness of the particular company, that is similar, say, competitors, let's say, similar competitors vita value, because this hypothetical company vita value is not there
Yes.
now. So that is the answer.
Yes, sir.
You understand that through this exercise,
Yes.
so you need to think that, say, it's a beta value of a comparable firm.
Yes, sir.
Took the point? Yeah.
Yes,
Beta
understood,
value
sir.
of the comparable firm, comparable to your hypothetical firm, right?
Yes.
And maybe a competitor in the market.
Uh-huh.
And then now, of course, that this kind of project, when we are initiating,
Yes.
now, of course, quantitatively that you have done some of the, I mean, almost all calculations, including working capital as well, and the
Yes.
machine cost and as well. Then I have a concern. Let's say now, when that companies are going for project evaluation or the capital budgeting decision,
Yes.
more or less considering what is called the environmental factors and other related unexpected costs as well.
Yes, sir.
Now, of course, that you have not included. So, but for the sake of understanding, because that you are, that working somewhere in the future, you might have an opportunity to prepare your own, the what is known as a capital budgeting proposal to the company where that you are working.
Yes.
So, my specific question is that what sort of that other factors do you think that which might affect to this kind of capital budgeting decision?
The non-financial factors that we have to consider,
Yeah.
uh, I think, sir, now when we are uh, using this kind of a machine, one factor would be that the training of the workers,
Okay.
because it's a new technology and
Hmm.
our workers are used to the traditional machines that are used in Sri Lanka. So therefore there might be a cost of training, and we might have to get experts from that country in order to train our workers. That's one aspect that deals with the human resource factor. And another thing would be, now these heavy machines usually tend to produce waste and waste management system, and that could lead to problems from pressure groups. Those things I think we have to deal with as a company.
Hmm. Yeah, that's right. Now, well, that you have defended, but then did you concern about the location as well? When new machine is installed, the locational study, suppose that this project is a maiden project, I mean a new startup, for
Yes,
simple
yes.
word, new startup. So then, did you that think of, if your this hypothetical company, suppose that this would be a new startup. In that case, what sort of costs that involve, that do you think?
That of course uh, didn't actually think of that, sir, but
Think and tell me,
since
because that is important for the knowledge. Think and tell me.
we are actually hypothetically actually we are running a factory space, so
Hmm.
therefore we could do a little bit of layout planning and arrange our factory floor
Yeah.
so that this machine could be properly placed.
Yeah.
Uh, but I didn't think of hiring out another factory space for this machine.
Hmm. Say for example, if the government is giving a land, so therefore that you have to incur some sort of let's say preparatory cost, like that having that facilities and building and
Yes.
say water and other sanitation facilities and everything that you need to consider. And therefore in the
Yes.
capital budgeting, I think you must have heard there are some other costs, like that sunk cost, where that never that
Yes,
you are
sir.
going to recover. Suppose that there is
Yes.
no for the project office or to the project location, there is no that developed road. So therefore that you need to put
Yes.
up a new road. And suppose
Infrastructure
that there is no
development.
water facilities, like pipe borne water. Therefore that you
Yes.
need to that, let's say, construct that either tube well or traditional well, where that you need to dig the earth and everything. So again this cost is part of the capital cost, right? But
Yes, sir.
maybe it will never recover, like that the government has done what is called expressways. And
Yes, yes.
apart from that, in case of capital budgeting, you are very much aware. Now, sometimes the how the waste water of the production process that you are again releasing to the environment hazards are there. Maybe that another capital cost is there, that you have installed the water treatment plant, where the output that you are using for that so watering the plants within the factory premises and all. So these are the some of the concepts that you need to consider while that you are trying to. Now are you getting me?
Ah, yes, sir.
Okay. Now those are the didn't you get my point?
No, sir. The connection, I don't know. I
Huh?
couldn't hear you. I couldn't hear you, sir.
Okay, right. Lot of things that I told you. Anyway,
I.
I cannot repeat it. But
Okay.
say, in case of capital budgeting, to tell you,
Yes.
now some of the environmental concerns, let's say the waste water of the factory of the ice cream. So what we are
Yes.
that going to do, maybe that you need to add some more that capital investment to set up the water treatment plant,
Yes. Yes.
right? And these are
Yes,
also
sir.
that part of the costs. And
Yes.
then one more thing, very specific, this one. Now when the now you have done IRR, NPV, and again payback.
Payback.
So according to your project, payback is
3 years and 4.5 months,
three
sir.
years and 4 months, let's say.
4 months. Okay.
4 months, right? Then what is the that the lifetime of the machine?
Lifetime of the machine, sir. Um, 5 years.
5 years. So it means
Yes.
that to earn the machine cost, it takes 4 years and 3 months.
3 years and four
Yeah, three
months, sir.
years and 4 months. Okay.
Yes.
Now, in the capital budgeting or the capital budgeting process, it says that of course, yes, that you have done not only the NPV, and the always traditional technique is completed due to the reason, due to one reason. What is that one reason?
Uh,
I said
the
that
neck.
again, if I repeat, say
Yes.
all the companies are doing NPV and IRR, but at the
Yes.
same time those companies again applying traditional technique like payback method with a reason.
Yes.
I'm asking, what is that reason? You know that.
That is to see whether our project cost can be recovered before the end of the project,
No,
sir.
that's right.
That is,
That's right. That's right. No. The thing, the real answer is that because traditionally handles traditionally handles the risk
yes,
of the project if the project proponent is calculating payback period as well, because whatever the
uh-uh.
investor always prefer to always prefer to recover his initial investment as soon as possible. That is the
Yes,
answer.
yes, correct.
Therefore, if
Yes,
the investor of the capital project is recovering his invested capital very soon, there is no risk, no.
yes, yes.
That is the answer. So these are the things that you need to learn.
Mm-hmm.
These are the things that, let's say, you said that 5 years, the lifetime of the, that machine, it means that
Yes,
depreciated within 5 years, but, three
yes,
years and 3 months or 4 months, it takes to recover. It is also
yes.
too long. Therefore, in case of, capital budgeting, there are, that consideration, what is called short term and long term projects. You need to learn that. Short term and
Mm-hmm.
long term project. What is short term project
Right.
and what is long term project? Short term project refers to the very soon your initial investment is recovering.
Uh-huh.
It doesn't take that much time. Long term
Right.
projects are there where initial investment to recover it will take long period. So
Mm-hmm.
therefore, in the capital budgeting, so a classification is there that always what is called the short term and long term projects.
Right,
Right.
sir.
So I advise you to just to that think of those factors as well.
Okay, sir.
Right. Anyway, Anupama. So thank you very much. Good presentation. Right. You
Thank
have
you very
included
much, sir.
almost all that ingredients to your presentation. Okay.
Thank you very much, sir.
Thank you.
Thank you.
Right. Who will be the next presenter? You're presenting. Here. Come. Good. Next presenter is Herath.
Yes, sir.
Okay. Okay. 36. What is your name? Virakodi. 36. Yeah, 30. There is no 36 now. Your number? This one. Ah, yeah. Right. You can start. You can use this one. You sit and do. So have you uploaded it to this site? Here. You have did you upload to this that this site? Dropbox. Do you have a pen drive? Do from here then. Are you ready? Okay.
I'm ready, sir, but I can't see that button. That's a present now button. Previously, it was on my top of the screen, but now it's not there, sir.
there is a button take over presentation. You
Yes,
just
before the
upload
first,
and take over the presentation.
yes, I already uploaded the presentation. Before the first presentation, I saw that button on my screen. Now it's not there, sir.
Why?
I will rejoin the meeting, sir. Then.
No, that first try that. So there is a button take over the presentation.
Yes, I saw it before the first presentation. Now it's not in the top on my screen, sir.
Okay, wait that we will set it.
Okay, sir. Thank you.
Good morning, sir. Good morning, my colleagues. Today I am going to evaluate a hypothetical project in order to check whether we can accept this, whether we can accept or reject the project as an investment. Basically, my project is a cosmetic company considering to introduce a new lotion. They have bought a new machine in order to produce this lotion, and the cost of the equipment is machine is rupees 350,000. Lifespan of the boat machine is 5 years, and we need additional capital of 10,000, and required rate of return is 20%. The tax rate applicable is 45%. Uh, in order to check whether check the riskiness of the project, we have applied lower boundary and upper boundary for the data that we have found through the market survey. With the market survey, we found that annual sales will be about 100,000 units, and the selling price would be rupees 12, and variable cost would be rupees 6, and fixed cost would be rupees 450,000. And to assess the riskiness, we have applied these values for the lower boundary and upper boundary. And we have prepared the projected pro forma income statement for the all three cases. And we found that at the worst case, we are making a loss. And in the base case, net income would be rupees 44,000. And in best case, net income would be rupees 407,000. And then we have analyzed the cash flow that we are arriving through these three scenarios. And in both worst case and the base, in worst case, the cash flow would be negative, and in the best case, uh, cash flow would be 78,000 per annum. In the best case, it would be 144,000 per annum. Projected balance sheet would be like this: net working capital 10,000 and net fixed asset 350. The machine would be depreciated in straight line method, and at the end of the project lifetime, there would no any scrap value for the machine. And we have analyzed the projected cash flow based on the change in net working capital and capital spending. In the worst case, we find that throughout the lifespan of the machine, we would not get any positive cash flows. Hence, it would be hence we won't be able to calculate the payback period, as we cannot recover the machine cost within the lifespan of the machine. And in the best case, we would get 78,000 per annum, and in the last year we would get 88,000 rupees. In the best case, we would get 144,000 per annum, and in the last year we would get 154,000. As I said earlier, when calculating the payback period, we cannot calculate the payback period as for the worst case, as all the cash flows are negative. In the base case, we would recover the initial investment within 4.68 years. For an investor, it is basically not a better result. Hence, we have calculated for the best case, and for the best case, it would be yes. Because I had made some error in this because
Some errors.
while feeding the figures, somehow in the best case, I found that within 2.52 years it will be recovered. And we have analyzed the net present value for the all three scenarios. Even for the base case, the net present value is a negative value.
Worst case.
Even for the base case. Worst case is almost negative.
Yeah.
Even for the base case, only for the best case we arrive with the positive value. And when analyzing the internal rate of return, we found that for the base case and for the worst case, we can't find the internal rate of return, as all our cash flows are negative. For the base case, it is just 2%, which is below our required rate of return. Only for the best case, we arrive with acceptable value, which is higher than our required rate of return. As per the summary, we can find that worst case is something. Worst case, we cannot accept it at all. Even the best case, as the cash flow net present value is minus and IRR is below the required rate of return, even we cannot accept the base case. Only the best case is up to the required level of the investor. Hence, it is advised to accept this project if only we can adopt the precautionary measures to reduce the cost and to make sure that the required sales margin can be achieved. Otherwise, it is recommended not to accept this project. Thank you very much.
Good. Now, so why that you have done, that 3 scenarios? What is the reason?
To analyze the riskiness, because when a market survey is done, when we come with some values that we don't know what will happen in the future, we can't exactly predict the amounts that we are going to sell and we arrive in our income.
So therefore, there are 3 scenarios. So that's good. So because let's say different capacity levels of operation. That's the reason. So that did you study something out of this? Because you have applied also that what we have done fundamentals, right? So then did you learn really that how to make that project proposal? Let's say your bank that needed to go into that new project where that your let's say director assigned you to prepare a project proposal. So now with this, that the studies that or the outcome that you have obtained from the masters, will you be able? Do you have confidence to prepare a project proposal?
Kind of.
Huh?
Yeah.
Kind of, no?
Yes.
Right. So then, again, that your tax rate is very high. Why that you put a very high tax rate?
45%.
Yeah. 45% tax rate is not there in Sri Lanka. Right? What else? What else that? What assumptions that we need to make? Yes. What assumptions that do we make when that you are doing this kind of project? Risk factor is okay, right? Now it means that in your hypothetical project that you need to consider for the implementation of the best case. The best case is that where that the machine that you need to operate at the optimal level. Am I right?
Yes.
If the demand falls, definitely, so project is not generating returns to the shareholders.
Sure.
Okay. Right, good. Good. Right, good.
Hello, sir. Hello, sir.
Yeah, you can. Who is that
I,
here? Yes, you can start.
so I'm Herath. Can I start, sir?
Yeah,
I
you
already
can start
uploaded.
now. Yeah.
Can you see my presentation?
What is your present? What is your number?
Number 17, sir.
Yeah. Now I can see your presentation. Yes. Go ahead.
Okay. Okay. Thank you, sir. Good morning, sir.
Good morning.
My hypothetical project is a manufacturing company which manufacture tires.
Yeah.
Yes.
You adjust your speaker. Speak loudly.
Okay, sir. My hypothetical project is a manufacturing company which manufacture tires.
Okay.
First slide we have the basic information and figures. My initial investment would be 5 million. I have to import a machine cost 3 million for this production. Tax rate is 30%. It's the prevailing tax rate of the country. After the 5 years, I assume that the machine can be sold for 1.2 million. Then the next slide, calculation of cost of capital. For the beta value, I have taken a beta value from the Seat tire company.
Okay.
That's my comparable firm to my hypothetical firm. Then the other slide, I have production and sales information for the 5 years period. I taken the number of units. Here my assumption is the units I produce for the whole year will be sold over after the end of the year. My growth rate of sales is 6% and the selling price growth rate is 7%. Then I take the figures of total profit after the deduction of the unit cost. Then I have pro forma income statement. Previously calculated gross profits are used here to calculate the earnings before interest and tax. Here interest expense is the bank loan interest which I was taken for 1 million at a rate of 10%. After the 30% of tax deduction, I have the profit after tax for 5 years time. In my cash flow statement, initial investment is mentioned at the beginning of the 0 year. It means 5 million. Then earning before interest and taxes are there. Depreciation is my 3 million machine for the straight line basis for 5 years for the 15%. Then I took the residual value of the machine as 1.2 million after the end of the 5 year. In the pro forma balance sheet, it's in the 7th slide. Under non-current assets, we have the machine, and I already depreciate it and take down the written down values. For the equity and liabilities, I mentioned the profit after tax. For the non-current liabilities, here I mentioned 1 million is the bank loan which I taken the beginning of the project. Then I go to the analysis of this project by first calculating the payback period. I got the payback period of 4 years and 1 month. That's the initial investment I can recover before the end of the 5th year. It's 4 years and 1 month. And the NPV calculation is there. I got a finally I got a positive value of 779 835 figure for the NPV value. It's good because it's a positive value. Then finally for the IRR rate, I got 0.14. It's 14%, 36 percentage. It's greater than the discount rate of 10%, project discount rate of 10%. Then IRR is also good to accept this project. Is my decision criteria. As NPV gives a positive value and IRR is greater than project discount rate, and also payback period is under 5 years. It's 4 years and 1 month. Then as per the above results, I think our existing firm can accept this project. Finally, my assumptions made under forecasting is annual growth rate of sales is 6% and selling price is growing from 7%. Variable cost per unit and fixed cost are remain constant for the 5 years of time. And I already mentioned that one. And depreciation method is straight line method, sir. Thank you.
Is it over?
Yes, sir.
Now, what is the cost of capital? How did you obtain cost of capital figure? Herath,
Yes, sir. It's 10%.
it's
10%, sir.
huh?
10%, sir.
It is 10%.
Yes.
So that so how did you obtain this cost of capital?
I didn't mention it here, sir.
Yeah,
Uh,
because bank loan amount at 15%, right?
okay, sir.
Your cost of capital is 10%. Now you need to know that I mean justify it.
Oh,
Say bank loan, initial investment bank loan, 1 million taking at the
okay,
rate
sir.
of 15%. Then that cost of capital should more than the 15%. No?
More than 10%, no, sir.
Yeah, should be more than 10%. Then your
Okay, sir.
calculation is wrong
Sir, cost of capital
because
calculation is wrong,
you
sir.
as a
Yeah.
company, when you took, let's say, cash from that, your capital structure is 50-50%. Debt is
Yes, sir.
50 and then the equity is 50%.
Yes,
So
sir.
then you are paying, I mean, I'm not calculated, but 15% that you are paying for the bank loan, it can't be, cost of capital should be more than 15%. So it is not, that correct what you have done.
Okay, sir.
Cost of capital, I think you presumed that and you kept it. No, it is wrong. Did you get my point?
Yes, sir. I just
Your
assume
debt
it as the.
capital is paying 15%, but
Okay,
you
sir.
have, that I mean discounted all cash flows at the rate of 10%, less value. It is
Yes, sir.
wrong.
Yes, yeah. I got the point, sir.
You need to consider that,
It, okay,
right?
sir. Then it should be more than that, no, sir.
Yeah, you need to, I mean, calculate it. What is the tax rate? 30%.
30%, sir.
So you
I
need
got
to
it
show
from the.
that even the calculation of the cost of capital, that in the previous presentations they have done it, right?
Yes, I saw it on the first presentation. I saw it, sir.
You need to concern on that.
Yes, sir.
Okay,
Okay, sir.
right, okay.
Thank you, sir.
Right, next presenter who is Yehiya? Okay, start. You go to the present PowerPoint files and start your presentation. Take O as a present. There is a button. Take O as a present. Not this slides, your slides. Yes. Where are you? Start your presentation. So where is your presentation? Okay, that you ready that I will take the next presentation, right? Till you ready. He has downloaded, no, here? Come. Present PowerPoint slides. Present now. Where is that? You want? Here. Desktop. This one. Here. This one. Yes. All right.
Good morning, all of you. This is also a high.
So we need to record it. Okay, go ahead.
Good morning, all of you. This is also a hypothetical example. A famous beverage company is considered to introduce a new soft drink. Following information is there. The cost of equipment is 150,000, 750,000, and lifetime of the project is 5 years, and additional working capital 20,000, and required rate of return 70%. Tax rate is 30%. After doing market survey, we can take these lower base and upper boundaries, and sales unit in base case 500 and selling price is 2,500. Variable cost is 1,500 and fixed cost is 200,000. Then to accept the new project, we have carry out sensitive analysis. Project to doing sensitive analysis, we here is the projected pro forma income, and we can find net income for worst case is 14,000 and best case 105,000, and this one for the best case. Then we find cash flows. These are three cash flow for these three cases, and projected balance sheet shows projected balance sheet shows for these amounts net working capital and the net fixed asset for these 5 years. Then there are projected cash flows for the worst case. Uh, it gives 164,000 for these 3 years, and after 184,000 for the worst case, and it gives for the best case 245,000 for these 3 years and 265,000 to the last 5 years. Then we calculate payback period. For the worst case, it counts 4 years and 6.61 years, and for base case 3.66 years, and for the best case it comes 3.14 years. Net present value we can calculate here, and there are minus value for the worst case and the base case. Only the best case shows the positive value for net present value, and then we calculate internal rate of return IRR for these 3 cases. It shows 2.92 and 11.91. Both are below the required rate of return, and only the best case shows higher amount than RRR. So all these summary shows only the best case is. So if we after this all calculation, we can get this conclusion. Even the best case NPV is negative, base case NPV is negative, and IRR below required rate of return. Only the best case gives the statistical profitable business. So if we select this project, we must reduce the cost and keep sales in required margin. Thank you.
It's similar to my example, almost same example. Huh? Anyway, that you have mastered that one. Do you understand this?
Yeah.
Now
I can understand.
Now that you can understand, so that's what we need to do now. So I mean, so not always needed to do the scenario analysis.
Yeah.
When the actual figures are there, like whatever the land or the building or the machine cost, and then of course you need to presume that market demand. Then based on whatever the number of units you are selling, so then that you need to multiply from it. So then that you need to build up the what is called project proposal. Let's say for example, like let's say if I ask a question very simply, if it is a service organization like a bus operator, how that that he is going to that prepare a project proposal? You think and tell us. Say bus operator. The person is purchasing a bus, right? Let's say now Ashok Leyland bus is let's say 6.5 million. Let's say 7.5 million. So span of the project is project life is bus let's say 4 years, 25%. So then how means that I am going to calculate income?
Depreciating.
No. That's what that you need to learn. How do you calculate? Let's say from the company itself, there is a warranty for the engine. Let's say that 400,000 kilometers or say 1 million kilometers can run, right? So that if he is a person who is knowing, suppose that he has a road permit, say Kalambutu can be. Up up and down. So let's say 180 plus kilometers, 360 kilometers per day. So then that, let's say, assuming that 20 days per month, right? Then 20 days per month. Then that you need to multiply, right? Then after that you need to know cost of the project. Let's say every let's say 5,000 kilometers there is service required. Then fuel cost, right? Then wear and tear, like that tires and everything. So those are the costs. So then you need to go for the pro forma financial statements. Because both of you have not done that, right? I mean preparing pro forma financial statements on what basis? All on assumptions, no? Right? For the future 5 years, this much of sales, this much of variable cost, this much of fixed cost, right? This much of interest, this much of selling and administrative cost. You understand? Those workings that you need to know. Then after you can prepare project proposals. Like I mean previous. I think your present. You go back to the presentation again. Did you do that? What is called the
Yes.
yeah, no, that I need to see. I need to see the project cash flows. This is a balance sheet, pro forma financial statement. This is balance sheet. This is again project cash flows. Go back. Have you prepared? No. I'm asking where the figures came in. Yeah, this one. Right. Okay. Right. Good. Good. Right. So what is your number? 60.
Yeah, are you ready?
Yes, sir. I'm ready, sir, but I could not see my presentation, sir. So, is it possible to upload from your side, sir?
What is your number?
054.
054.
I have uploaded in attachment. Oh, can I take over from my? Can I present through my PC?
Just a minute.
Thank you.
Okay. You take over.
Yeah, take over.
Take over. Right. Okay.
Thank you. So can I start?
Yeah, start it.
Good morning, everyone. My presentation is about putting up a business in Pasikuda. This is a resort project. This is the hypothetical name for the project. It's named as a Blue Lagoon Resort, situated in planning to put up in Pasikuda.
Okay.
This is the initial investment is considered as 250 million. These are hypothetical figures. Is planned to develop 40 rooms in this boutique resort project. As a room rate based on the industry rate in the Pasikuda area, as a full board basis, I have considered 23,000 as a room rate per day. And as a fixed cost, as a hypothetical figures, I have estimated as 25 million each year as the fixed cost. This is my pro forma income statement. In the pro forma income statement, when we consider about the sales figures, here in the sales, to arrive the sales figure, I have multiplied 23,000 room rate into 40 rooms in order to arrive the income per revenue per day, and also I have multiplied into 365 to arrive 1 year complete sales figures. When we consider about the sales figure, in each year it's assumed the sales will increase by 4%. As a variable cost, here I have considered 100,740 as a variable cost per annum. I have considered 30% of the income as a variable cost. I remained 70% as a 70% as a gross profit. Here I have considered fixed cost as a 25 million because of a straight line method, and the depreciation is considered as 50 million because the property, plant and equipment is considered 250 million. It's depreciated throughout the year, and earning before tax is given. As the interest rate also considered as 12% because the part of the capital is obtained from the long-term borrowing. Based on that, we have arrived the earning before tax. As usual, the corporate tax rate is considered as 28%. This is the estimated. This is the earning after tax. Next, I move to the pro forma balance sheet. You can see in the pro forma balance sheet, the property, plant and equipment is considered as 250 million. In order to fund for the 250 million, we have planned to obtain 150 million from the investors and 100 million through the long-term interest-bearing loans. These are the cash flows throughout the project. These are the pro forma balance sheet throughout the 5 years of 5-year lifespan of this project. To arrive the net operating cash flow, here I have considered earning before interest and tax each year, and I have added the depreciation, and here I have deducted the corporate tax in order to arrive the net cash flow for each year. This is the projected cash flow. In first year 250 million we are investing. In the first year 168 million as a net cash flow we are getting. The second year is 176 million, and third year we are gaining 185 million, and fourth year is 194 million, and fifth year is 203 million. Now I'm going to the project analysis technique. The first project analysis technique, I have considered the payback period. Based on this analysis, the payback period of this project is arrived 1.5 years. Mean the project, the initial investment can be recovered within the 1.5 months of this project span. It's very quick. It's give very quick payback. To arrive the next calculation techniques is the project analysis techniques, the NPV, net present value. In order to arrive the next present value, here I have computed the cost of capital in the 250 million. 150 is mean 60% of from the equity and 40% from the debt. Here for the equity, I have considered 13% as a cost of capital. Is mean during the normal interest rate is 9%. I have added 4% as a premium. Here I have arrived 7.8% as a weighted cost. And for the debt capital, I have considered 12% as the interest rate. From that, I have deducted 28% corporate tax. I have arrived at these figures. And the final figure is 11.26% is a weighted average, weighted cost of capital. Based on that, in order to cover the volatility in the market, I have adjusted 1.1 as a beta factor. This is the beta factor I obtained from the similar firm which operate similar hotel, Aitken Spencer, which operate in the same area in Pasikuda. Based on that the adjustment, I have arrived at 12% as the cost of capital, weighted average cost of capital. This is the project NPV figures at the 12% weighted average cost of capital. Through the discounted cash flow, we can see the 412 million shows the NPV is a positive NPV value. And then as a next analysis technique, I have gone to the IRR. I took the NPV at 15% cost of capital to calculate the IRR. Based on that, this IRR is shown as a 38% is visible. The IRR is higher than the company's this project's cost of capital. Finally, as a conclusion, based on the payback period, it shows the very quick payback of 1.5 months, and also throughout the NPV also it gives the 412 million positive NPV at the end of this project, and IRR also shows the figure, the discount rate is higher than the calculated weighted cost of capital. So it is advisable to go for this project in order to enhance and maximize the wealth of the organization and shareholder. These are my references. Thank you.
Okay. Now, so this one is the hotel project.
Yes, sir.
Now again, so go back to the presentation and just describe me how do you estimate your that room rate 23,000.
23 rate because I didn't estimate, sir. This is the standard rate which I obtained from the website from the same hotels operating the similar companies operate in the Pasikuda area as a full board basis.
Okay.
During this time.
Then
and also I assume this hotel is operating
pricing you have done.
Yes, sir.
Okay. Now then let's say competitive pricing is okay, but at the same time that you need to justify that why that you are that using competitive pricing. If it is a new startup, so definitely that you need to attract customers as well. So therefore that to attract the customers, competitive the prices may not be a real rate, because always the whatever the tourists are looking for, that less cost the accommodation.
Yes, sir.
You understand?
Yes, sir. I agree, sir. And also I have a few suggestions, sir. Because this project is planned to locate in very good sea areas, but that is facing the sea. And also this is a boutique project. It's like single one rooms. It's not like apartment. It's like a single room. That's why.
Okay.
That's why I considered as and also it will be good for new things for the guest. That's why I have considered this standard 23,000 as a room rate.
Right. Now, so again, for the knowledge, and this is all, the financial analysis. So
Yes, sir.
other than this, financial, what are the some other associated factors when you are going to start up a new project like a hotel project to be considered in this kind of capital budgeting analysis?
Yeah, in the capital budgeting analysis, I need to consider about these mainly the infrastructure, because now only in the Pasiguda area the infrastructures are developing. Normally the drainages and the water supply facilities. Now gradually they are expanding their investment in the tourism, and also I need to consider mainly the initial investment, and also I need to consider the green concept in the hotels in order to decrease the cost.
Yeah.
Because normally in the Pasikuda area the occupancy rates are very less because of the it's not at that much populated area after completion of the war, post completion of the war. The company in the off-peak time need to operate in the minimum cost level, need to maintain the minimum cost level, and company need to attract the tourists based on its marketing campaign, a strong marketing campaign. In combination of in both cases, only the company can sustain this throughout the project lifespan.
Okay, right. Now, so this again the theoretical question. Now, your NPV calculation, it shows that the NPV is positive.
Yes,
right?
sir.
Hello. Its
Yes, sir.
NPV is
I
a
can hear,
big
sir.
value. It's 412 million.
Yes, sir.
So it's based on your calculations, no?
Yes, sir. Yeah, it's a hypothetical figure.
Yeah, it's a hypothetical figure, no? So
Yes, sir.
it means what finally? This NPV 412.5 million means what?
This is the discounted figures based on by adjusting the time value of the money,
No, that's
which
right.
will
That's
be
right. So I'm
which will
asking,
be obtained at the end of the
yeah,
project.
what's the real meaning of this? That's you need to know.
Throughout this project, by implementing this project, end of this project, we can achieve this much of money by considering the time value of money.
No. My point is that I ask now. This is the that we have done corporate finance. No, this is not the
Yes, sir.
hotel. This hotel, suppose, is not belong to a single person. So
Yes,
it
sir.
is the listed company, owned by
Yes,
the
sir.
listed company. So therefore, this much of NPV value recorded in your hypothetical figures, I'm asking what message this figure will be giving to the market.
It mean it will enhance it will maximize the wealth of these stakeholders, and it will attract the future potential stakeholders.
No, the answer is that you as master students, you need to know it means that this net present value created after servicing equity capital and debt capital according to your hypothetical example,
Yes, sir.
and this residual is available for the ordinary shareholders,
Yes, sir.
right?
Ordinary shareholders.
Through what? Dividends. If the ordinary shareholders wealth position is increased, because that's why after servicing debts, after the servicing equity capital, this much is available to the existing shareholders.
Yes, sir.
So therefore the share market also, this company shares will be up.
Will
Then
be up. It will,
then shareholder wealth is maximized. That is the
back to us.
that is the of course goal of the financial management as well.
Yeah.
Goal of the
Yes, sir.
financial management as well. Wealth of
Yes, sir.
the NPV positive means that shareholders wealth is maximized.
Maximize.
We go back then. How that we are going back? You need to say very specifically after servicing the debt,
That.
after
Yeah.
declaring dividends to the equity holders, rest
Yeah.
of the income is available to shareholders through dividends,
Dividends. Yes, sir.
right? At the
Yes,
same
sir.
time, not only accruing this much of income, so when the dividend is declared, that signal also pass to the market. As a result of that, the share prices of that whatever the particular company we are talking
Company.
will be
Yeah.
increased. So then,
Increase share price.
yeah. So this is the final outcome, right?
Yes, sir.
Right. Okay. Good presentation. You have done so a lot of work, homework.
Thank you, sir.
Okay. Thank you very much. Okay.
Thank you.
Okay. Next, we'll go.
Hello.
Hello. Yes, Vitanagi is there.
Yes, sir. Can I
Okay.
present?
Now you can start your presentation.
Okay. Hello. Can you see my presentation, sir?
Increase your volume, mic volume.
Yeah.
Volume. No, can you hear me?
Yeah. Yeah. So we can hear you.
Okay.
Go ahead. Yeah.
Just a minute.
Okay.
Okay. Take over the presenter and present. Right.
Okay. Start your presentation.
Okay. Good morning, sir.
Good morning.
For the assignment, I will do a replacement analysis,
Okay.
and in my hypothetical case, I will consider XYZ company which is engaged in printing business.
Okay.
And due to recent demand, existing printing machine is not adequate for the demand. Therefore, the firm is looking forward to buy efficient machines in future to
Okay.
cater the demand.
Right.
And they have come across with two machines. Machine one called Press A has a higher production capacity which adequate to meet the demand. Further, it has the capabilities to produce additional products than old press, which cost additional working capital if the machine A purchased. Then second machine is produced almost the same as the old one and with a high capacity. Then my evaluation process will take in 3 stages. First one is the development of incremental cash flows, then the calculating of discount rate, and finally capital budgeting techniques. When I'm doing incremental cash flows, there are 3 stages also. The initial investment, the incremental operating cash flows and the terminal cash flows. I have make some assumptions. First one is cash flows will may perform for all three machines. Second one is it will not include any sunk costs, which is irrelevant. The third one is the firm has adequate equity to purchase in new machineries. Cash flows are considered with current and future costs. Straight line method will be used for depreciation, and it will not incorporate inflation neither in cash flows nor discount rates in order to preserve inconsistency in our results. And the tax rate is 40%. And the initial investments, the purchasing cost of press A is 800,000 and the installation cost is 50,000. Press B is 650,000 and the installation cost is 30,000. And press A will incur additional 60,000 of working capital. And since I'm doing a replacement analysis, I always have to calculate the differential cash flows. Therefore, I have to include the selling price of the existing machine. The selling price of existing machine is 370,000 and tax on that is 148,000. Therefore, finally, the initial investment cash flow is 188,000 for press A and 458,000 for press B. Then the pro forma income statement. I will analyze three machines separately. For the oil press and all the machines, I have considered as a sales growth of 10% year to year, 10% growth in sales and cost of goods. Likewise, I have calculated the pro forma invoice for all press A and press B. Also, I have calculated the pro forma balance sheets for three machines separately. Then the projected operating cash flows. I have add back the depreciation to the net profit after tax to calculate the operating cash flows. And the final cash flow is the terminal cash flow. Here, after 5 years, the old press can sell for 100,000, press A can sell for 400,000, and press B can sell for 300,000. And change in working capital means that after the 5 years, the working capital incurred in the press A will come back. That's why I have added back. There also I have taken the differential cash flows because this is a replacement analysis. Then the summarized relevant cash flows. I have summarized all three cash flows into this. Therefore, the incremental cash flows for press A its initial cash flow is 188,000 and likewise. And for press B, initial investment is 458 and all are positive cash flows for next 5 years. Then the calculation of discount rate. I use the CAPM model to calculate the discount rate. For risk-free rate of return, I use the treasury bond rate. Prevailing treasury bond rate is 8.45 for 12 months treasury bond rate. So I consider RF as 8.5 and required market rate I consider 15% because the firm can easily take bank loan for 15% at any time. And the beta, when calculating beta, there is no comparable firm to get an idea about the beta, and also there are no historical values. Therefore, I assume the company as an aggressive company, so I took the beta value as 1.2%. From that CAPE model, the required rate of return was calculated as 16.3%. Then the evaluation process, I used three methods: payback period, net present value, and the IRR. The payback period for both machines are less than 5 years. PES A is 3.84 years, and PES B is 4.36 years. And the net present value, PES A has a positive value of 14,470, but PES B has a negative value. Also, in considering the IRR, PES A recorded the 17.08, which is higher than the required rate of return, and PES B is less than required rate of return, and it's 8.42. And I use linear interpolation method to calculate the IRR. Therefore, my conclusion is to go for PES A, which has a positive NPV and IRR is higher than the required rate of return, and not by selling the old one. Thank you, sir.
Okay. Now, so you have done different presentation, and so I appreciate. And by looking at the replacement of the machine,
Yes, sir.
then therefore that your conclusion is that purchasing a press A is that would give much more advantages. Am I right?
Yes, sir. Then press B. Yes, sir.
Yeah. So then you have calculated what is called payback, net present value, and IRR.
Yes, sir.
And in case of IRR, it is so negative, no?
No, both values are positive, but the press A
No.
is more than.
No, project A is positive, project B is negative.
Yeah, net present value is negative, sir. The IRR is less than required rate of return.
Oh, okay. IRR is less than the required rate of return, no, bigger than the required rate of return.
Press A, it's higher than the required rate of return, and press B is lesser than the required rate of return.
Okay, right. Now, what does it mean that calculation of terminal cash flows?
My lifespan of the project is 5 years.
Okay.
And after 5 years, the project will stop. Therefore, we have to sell our machines. The selling price, I took the terminal value as the selling price as the terminal value.
Okay. So that's why that you have considered as a terminal value.
Yes, sir.
But we are not writing like a terminal value, because in finance, terminal value has a separate meaning. Yeah, you understand?
Yes, sir.
So we are not using terminal cash flows, right? So cash flows for project analysis. You understand that?
Yes, yes, sir.
Right? Don't do this mistake. Maybe that some of the books that printed as terminal cash flows, it is wrong, because I have been doing with you the say by referring to the different books. So every book, not the that terminal cash flows, terminal value has a separate meaning, as I told you.
Okay, sir.
Therefore, what is called in capital budgeting? Cash flows for capital budgeting, operating cash flows, right? Don't use this wording. You understand?
Okay, sir. Yes, sir.
Okay, you can do it. Very good presentation. Good that you have done a lot of work.
Thank you, sir.
Okay.
Okay.
Right. Okay, next presenter. Jayadilaka is there?
Priyanka is there, sir.
Hello?
Priyanka is there, sir.
What?
Ranasinghe.
Rana Singh, okay.
Yes, sir.
You start then.
Okay, sir. I would see the upload of my presentation.
Did you upload it?
Yes, upload. I want to take. Still, I can't see.
Okay. So I see it. Okay, you load it.
Good morning, sir.
I don't see your presentation.
Now I can see the presentation on the whiteboard, sir.
Yeah, from your side, but I can't see you.
Is it possible to help, sir, to upload to see you, sir?
Just a minute. Yeah. Your number is 49.
Yes, sir, 49.
Okay,
Yes.
start it, right.
Okay. Good morning, sir.
Good morning.
I am going to present my forecast project proposal.
Okay.
This is a hypothetical projection called WAMCO is a leading marine solution provider in the market and planning to expand their business into marine paint market. The company has decided to purchase a marine paint mixer to reproduce the marine paint on customers' requirement. Company forecast to sell 10,000 liters during first year and to increase the sales by 5% year-on-year basis. Unit selling price of 1 liter during first year will be estimated to 1,500 rupees and to increase the selling price by 2% year-on-year basis. So we have forecasted the variable cost per liter will be about 1,100. This for that we have decided to purchase a machine. This is to mix the paint. This machine typically have a 5 years of lifetime. The estimated annual fixed cost for the project would be about 1.4 million, and company needs to invest to purchase this machine 7.5 million, and also further 2 million is required for the net working capital, and company will invest this fund using their equity capital, and also it is assumed that the prevailing tax rate is 28%. So if you focus on the financial highlights, sales projection for the investment are estimated to begin at 15 million the first year, then it will increase to 19.7 million in year of 5 during the plan period. The business is expected to make profit from the first year operation. The net profit is projected at around 792,000, but it turning around to 1.1 million in the second year. The third year about 1.5 million, and 2 million around fourth year, and 2.4 million at the year 5. So when we analyze the ratios, the gross margin for the business will be reasonably maintained as per the industry benchmark. We can see the figures later. The net present value of the cash flow at the end of the year 5 will be about 3.5 million. The business maintain an IRR about 21% over the 5 years planning period. The total investment payback within it will be recover within 3.5 years, and takes about 4.1 years for the if you calculate based on the discounted payback method, so if you now we'll look in how these figures has been arrived or derived by using the calculations. So before that, the objective of this report or the proposal to analyze whether the project is financially feasible. Actually, based on the figures which is arrived, projected financial business case indicate that the project is financially feasible with a net present value of 3.5 million, and also that will be covered during 5 years period, and also maintaining IRR of 21%, which is higher than the cost of capital. The nominal payback period will be about 3.5 million, and also the discounted payback period will be 4.4 years. So when you come to to arrive these figures, we need to prepare the pro forma financial statement. So in my introduction, I have mentioned the assumptions that how I am going to derive these figures. So based on that, during first year, we are forecasting to achieve 15 million of sales during year 1, and year 2 about 16 million, year 3 17.2, likewise end up with 17.9 million. So variable cost also based on the assumptions, during the first year it will be around 11 million, 11.5 million, 11.1 million, 12.7 million, and end up with 13.3 million. Likewise, based on the figures, now it was assumed that fixed cost will be about 1.4 million per year, and also since this machine, the lifetime is end up with 5 years, the depreciation based on the straight line method, it will be about 1.5 million per year. So based on these figures, the EBIT, earning before interest tax, will be 1.1 million during first year. The second year will be 1.6 million, 2.1 million, 2.7 million, and year 5 3.4 million. So the prevailing tax rate would be about 28%. So after deducting the tax, net income will arriving at the first year 792,000, 1.1 million in the second year, 1.5 million in year 3, and 2.4 million at the year 4. This is how the figures that I have taken for my pro forma financial statements. So as I mentioned earlier, unit sales would be increased by 5% year-on-year basis. So first year we have forecast to achieve 10,000 liters. Likewise, it will be increased by 5%. So selling price also will be increased by 2% year-on-year basis. Likewise, I have figured out all the workings for the pro forma financial statement. So next fixed cost, net fixed cost will be reduced because of the depreciation. At the end of the year 5, it will be 0, since the lifetime of the project is, or the machine will be 5 years. So when you come to the project capital requirements, we have forecast we need net working capital of 2 million, and also the net fixed asset would be year 0 7.1 million, that is the purchase value of the machine. Then year 1 will be 6 million, year 2 4.5 million, year 3 3 million, and year 4 1.5 million. So the total investment based on that, year 1 it will be 9.5 million, and it is end up with the 2 million, that is the net working capital which we have introduced to the business. So operating cash flows, when you take the earning before interest and tax, we need to add back to obtain the net operating cash flows. We have to add back depreciation since we have already deducted. So, and also then we need to deduct taxes, and since we have already taken the earning before interest and tax. Based on that, the net operating cash flows year 1 would be 2.2 million, and then year 2 2.6, year 3 3 million, 3.5 million in year 4, and 3.9 million end of year 5. So projected cash flows, based on that, I have mentioned the above also. So based on that, the end of the project, the total cash flow will be about 5.9 million. So, so how we need to get that projected cash flows and the NPV, now I am going to derive. So based on the cash flows, then we have to discount this cash flows. So to discount, I have applied the discounting factor as 9%. How I have arrived this 9% will be is described in this slide. So since this is totally on equity finance, so just I have to calculate only the cost of equity. So based on the figures, I have used the CAPM model to derive cost of equity. So I have taken the risk-free rate as 12.3%. That is actually I have obtained this one from the industry figures, and also it is mentioned in this slide. This is, since this is a 5-year project, I have taken the 5-year treasury bond rate as 12.3. Also the beta factor, it is then, since this is chemical related industries, I have taken the Union Chemical Lanka PLC's beta factor as the comparable beta factor. So that is 0.6761. Also I have taken the market required rate of return as 7.3 based on the industry's rates. So that is how I have used to calculate the cost of equity. So finally I have arrived approximately 9% as my cost of equity. So coming back to the NPV, so based on the calculation, so it indicates that the positive net present value will be arrived. That is the initial cost less the projected cash flows. So total net present value would be about 3.5 million. So it is a positive sign that the net present value is a positive figure. So, so I have analyzed another technique to see whether the project is financially feasible. So for that I have taken, apart from the net present value, payback period. Based on the calculations, it was derived that it takes 3.5 months to recover the initial investment. So that means within the forecasted period, the investment will be recovered. And also further, I have checked with the discounted payback period and also the IRR technique. So according to that also, according to the discounted payback period, it takes about 4.1 months to recover the initial project cost. So it indicates a positive sign again. So based on the IRR calculations, I have used to obtain the IRR calculation the Excel formula. So based on that, the IRR would be about 21%, which is higher than the cost of equity. So that means the conclude to the presentation, the net present value also will be positive, and also the IRR would be above the cost of equity. Therefore, it recommends to go forward with this project, since the techniques for the project evaluations almost all showing the positive signs. So that is end of my presentation. Thank you very much for the listening for my presentation. Hello.
Good. So I mean, comprehensive presentation. So you did lot of calculations as well and put the notes. And
Yes, sir.
so this is regarding the what is called the operation of
this industry is a marine industry, so they come. So they are, now we are going to introduce the marine paints.
Yeah.
Yes.
So then the marine paints, and you, according to your conclusion, you have arrived all the figures based on the forecasted selling number of liters, 10,000.
Yes, sir. Yes.
And this 10,000 liters again, year on year, this will increase by 5% the demand in the market.
Yes, sir.
Right. Then you took the variable cost per liter 1,100. Am I 1,100
Yes.
per liter or what?
Per liter, sir. Yes.
Per liter estimated cost is 1,100.
Yeah.
Per liter.
Yes, sir.
Oh, too much, no?
Actually, sir, it is now if you refer to the industry rates, the GP rate would be about 30%. So if you consider the slide number 13, you can see for painting, the gross profit margin would be about 31.3%. The average I have taken as 30%.
Okay. Right. Good. So then one more question. Right. Then you have calculated the cost of capital. These are the important figures. 9% based on again this calculation. So what is the how did you assume Vita as Vita value?
Vita value is 0.6761. That is based on the comparable rate that I have taken from the Union Chemical Lanka PLC.
Right.
That is a comparable rate.
Okay. So what does it mean? That what is the meaning of 0.6761? What's the meaning? Yeah. When we say okay, now your justification is right. I am asking one theoretical question where. So if it is the riskiness of the whatever the company is 0.6761.
Yeah.
What indicates to you that?
It indicates that the beta is below 1%. That means it is less volatile. Yes.
Yes. Less risky company.
Yes.
Okay, right. So then, do you know some other methods of calculating cost of equity?
We can use WACC also for WACC, but I didn't take because this is based only the cost of equity.
Why that only you took cost of equity for that for this company?
Because the funds we are using from the equity finance, the return earnings.
What?
The funds based on the equity capital.
Okay, right. So it means that this WAMCO, your hypothetical firm, has finance only through the equity.
Yes, sir. Yes.
Okay, right. Okay, good. Okay, very good. So you have done a lot of calculation. Appreciate.
Yes, because we are doing the project cash flows forecast for the companies to obtain loans. So based on my experience, I have derived these things, sir.
Good, good, very good. Okay, so
Okay,
thank you very much.
sir. Thank you, sir.
Okay. So next we have one Jayatilaka.
Yes, sir.
Are you there?
Yeah, I'm available, sir.
Okay.
So my number is 40.
Yeah, take over as a presenter. Okay, I will return to the next presenter.
I have taken
Right.
over.
Okay, load it. මම හදාගත්තා ඊට පස්සේ. ගත්තයක් කරනවට හරියන්නේ. එයා ගන්නවා තාමනේ. Speak loudly.
Yes.
WA Jayatilaka. ඉස්සෙල්ලම ඇවිල්ලා ආපහු ගියේ එක්කෙනා.
Hello. Hello.
Hello. Yeah.
Take over the presenters.
Take over as a presenter.
Yes,
There is
yeah,
a button called take over as presenter. You click on that.
yeah, people.
මේ select කෙනෙක්.
Not coming.
නැත්නම් මේක අපිවත් අප්ලෝඩ් කරලා.
Upload your presentation. Hello. Hello.
Mr. Jayatilaka. Upload your presentation. ඉන්නවා.
Jayatilaka.
Yeah.
Listen. Hello.
Are you ready now? Mr. Jayatilaka? Hello? Now it's okay, no? Hello? Yeah, your mic is mute. You just unmute it.
Yes, sir. Now can you hear me, sir?
Yeah, now it's clear. Go
Yeah,
ahead.
thank you, sir. Then welcome. This is a presentation on financial feasibility of Gauss manufacturing project,
Okay.
which I have done for my presentation.
Okay.
I can give the profile of the proposed project. This is the manufacture of cotton gloves using Chinese automated machines for local market. And the approximate investment is Sri Lankan rupees 15 million. And the net present value is 6.5 million with payback period of 2 years and 1 month. And discounted payback period is 3 years and 3 months. And IRR is calculated 25% and cost of equity is 10%, and which details I will give in next slides. This is the pro forma revenue statement, sir.
Okay.
With the sales and the cost of sale, fixed
Okay.
overhead, depreciation and earning before interest and tax, and I assume the tax rate at 28%. A standard calculation and the net income is arrived. Then the pro forma financial position for 5 years. This project's life period is 5 years. So it shows like this. Then the projected operating cash flow, this you can see initial capital outlay 15 million with cost of machineries outflow is 13 million, meaning the 2 million is the working capital requirement initial. So I arrive at operating cash flows 5.8, 4.3, 4.9 and 5.5 and 6.1 for the 5-year period. Then this is the formula I used for cost of equity calculation, capital assets pricing model, and the 12.3 is average treasury bill rate plus this is the formulas I have used. Risk-free rate of return, treasury rate I have taken for 5 years. I have given the link that from where I have taken that detail. Then the beta value for similar size was not available in the Colombo Stock Exchange details. Therefore, I have taken the similar type of business, which is Hayes Fabric, who is manufacturing knitted fabric. It is 1.25. So that was I taken from Colombo Stock Exchange website. And market rate of return, I assume as 10%. Then the payback period is 2 years and 1 month. And discounted payback period is 3 years and 3 months. So in order to arrive at NPV, I have calculated the same cash flow at 25% and arriving at 245 negative. So using the negative and positive NPV calculations, I have arrived at internal rate of return of 25%. When calculating this project, these are the assumptions I have considered. Average number of days per month is 25 with 8 hours working, excluding lunch and tea time. Assume time waste 20% in the year 1 and improved in 10% thereafter. Production waste is 2% from the first 3 years and 3% thereafter due to machineries getting old. Wasted gloves can be sold at Sri Lankan rupees 20 per kg. Gloves selling price increased at 10% on year-on basis. Cost of sale increased at average 5% year-on-year basis. Water and consumables increased at 2% on year-on-year basis. Production time for gloves set is 4 minutes for the year 1 and 2 and 3 minutes for year 3 and 4 and 4 minutes for the year 5 due to machines getting old. Rent considered sunk since the machines will be installed at home. This machine is very small and I have personally seen these machines in working at one of my friend's place. No scrap value of machineries and investment funding is readily available from commission agent business. The person who is going to invest this is already a commission agent, so he has funding arrangements for this machines. So according to this calculation, NPV and payback, the positive NPV is just 6.5 million at cost of equity of 10%. investment is recovered within project period under payback method 2 years and 1 month, and investment even recovered within the discounted payback period of 3 years and 3 months, and 25% IRR is more than cost of equity. So we recommend the project is to be accepted. So this is how the project has run, sir.
Is that over?
Yes, sir.
Now, so why did you make this much of assumptions for these calculations?
In the end of the project, now in the case of rent, you see, somebody we can ask that 10 machines, where are you going to install? Where is the rent? Now, in the 10 machines we are going to install. So in any project evaluation, there will be assumption that is based on the project, sir. That is why I now see the rent considered sunk, because this machine is going to install at home. This machine, maybe 2 rooms is enough to install all 10 machines. That is why
yeah, what is that?
In the assumption, you can see the one assumption I am explaining, sir. Rent considered sunk, since the machine will be installed at home, because this machine is very small machine, and in 2 rooms we can install all 10 machines. So somebody can ask why the rent is not considered as the cost. So that is why I have put, and inflationary increase of gloves selling price and cost of sale also I have given, because so that any person who is going to take a decision, they can understand that the figures are fairly present. Otherwise, somebody can ask whether selling price, all the 5 years we are going to sell the same price, or all the 5 years you are not going to give the increment to workers, all the 5 years you are going to get the raw material same price. It is something not possible. So I have to tell that in advance that I have considered those things. That is why I have given this list of assumptions, sir.
Okay. Now the projected operating cash flow, you have pro forma financial statements that you have prepared. Then now tell me again. Now this is cotton gloves using Chinese automated machines for local market.
Yes.
And how did you obtain this? What is called, how did you assume this all information, sale of gloves, scrap, right? Now,
yes, sir.
How did you know that? Are you in the industry or what?
No, sir. Actually, friend of mine is in this industry, but he has tried previously these 2 machines and later he has given up. So I got all this, actually the selling price and how the scrap rate and what rate the scrap can sell, all those, and how the material locally going to purchase second-hand trade. All those information I got from my friends, sir. So these are the raw material figures.
Tell me that whether that your friend has calculated all calculations or that you have done it.
No. My friend doesn't have capacity. He is just businessman, sir. I only calculated, and he said after calculating that I want to see that, because whether he can apply the same thing for new investment.
Same thing for?
Actually, after he asked me why I am asking all this information.
Okay.
Then I told that for my masters there is a project evaluation.
Right.
Since it is 5 years, I can't take much bigger project, and within 5-year period project has to be start and finished. So when I was thinking, then only I told that your Chinese machines, it will not last long. In 5 years is enough. So this is why I need the detail. Then based on his information only, actually I calculated this timing, production timing, scrap selling price, and actual selling price is real figures. But this year-on-year increases, cost of sale increases, selling price increases, is my assumption.
Okay, right. So one more question. Now, this cost of equity, that why didn't you take only the cost of equity?
Actually, this is a 15 million project. It's not a very big investment considering the project.
Okay.
So there is no necessity to go to debt equity finance. So he is already in the this Amai Street businessman. So he has 15 million, enough money is there. Already he has done with the 2 machines.
It means that the answer should be this is not the what is called according to your explanations. This is not the what is called listed company. Am I right?
Yes, sir. This is not a listed company. This is a private business
company. And also, I mean, in the machine cost is now your answer, because you need to justify your answer, because I need to recheck it. Your in approximate investment is 15 million.
Yes, sir.
So then it means that the owner of the company has 15 million in hand to start up this business.
Yeah, he has money.
Okay, right. And
the machine cost also real cost, sir. 13 million. He himself told the one machine is this much.
Okay. So did you calculate this NPV? I mean, in the Excel sheet?
I calculated in the Excel sheet and then cut and paste here, sir.
Okay, right.
Yes, sir. All calculation done myself.
Right,
and
very
this
good.
Kind of calculation we have done in our job also.
Yeah. So this, this time now, do you see this internal rate of return, the formula that you have given over here?
Yes, sir.
So this you have copied from somewhere else. Am I right?
That rate, actually, sir, that rate, how to type in the Word file, and I find it difficult. So I got it cut and paste. Rate I know by heart, but the same way how to put it into the presentation slide, I find it difficult.
Okay. All right. Fine.
That is,
Good. So anyway, good presentation, and hope that you will perform at the examination as well in the same way, because what we found, not only you, that all the candidates were that not mastered what we are doing in the class, but through the presentation we realized today that everyone that of course very well studied.
Sir, my semester 1 exam results is B, sir.
B. What is the result?
B, sir.
B,
sir. And I am a CIMA student, sir.
Very good. Okay, good.
Okay, thank you, sir.
Okay, Mr. Jayatilaka. So good, I appreciate.
Okay, thank you, sir.
Appreciate.
Okay, sir.
Okay, right. Thank you. Right. Right. Sorry. Now today, so we are concluding our all presentations for the advanced corporate finance. One more presenter scheduled to be presented today. Name is name is Vijayvardhana. So therefore, what we have requested, you need to upload the presentation into the LMS box plus online no live presentation. So therefore, we are concluding the presentations from today only, and we will be having 3 more weeks to go, and we will be completing topics as we have listed in the course outline. In the examination, what would follow, what the course outline says, plus the lecture series we have followed. Accordingly, we will be setting our question paper. Once that, again, we are requesting you to follow our online video clips plus PowerPoint slides that we have uploaded, and also textbook also that we have uploaded. Please read relevant chapters and prepare for the examination, because our last the previous semester, the results are not up to our expectation. What we have done, then that what we have expected, the learning outcome, so we have not seen through the examination. So therefore that strictly advising you to go to the LMS, read PowerPoint slides with the whiteboard calculations plus that relevant chapters of the textbook. Okay, so that we are concluding the presentations from today. Thank you.